The 2026 FIFA World Cup is a massive financial engine. With 48 national teams arriving, millions in global capital will flow into the host countries. A total of 104 matches will be played, but the revenue generation is highly concentrated. As this map shows, the United States will host 78 of those matches across 11 specific cities. For the foreign national teams, independent athletes, and global promoters operating at these 78 venues, the window for large-scale revenue generation opens long before the final match. Under federal tax law, the money earned here is classified as U.S. source income. This means any earnings directly connected with athletic or promotional activities performed within U.S. borders are subject to strict U.S. taxation. The agency enforcing this law is the Internal Revenue Service, mandating uncompromising tax compliance on all foreign individuals and entities participating in these events. Any foreign sports entity planning to operate during the tournament must understand they are entering a highly aggressive tax jurisdiction. Surviving it requires immediate financial architecture. The core threat to a foreign team's balance sheet lies in how the IRS treats non-employee compensation for foreign independent contractors. By default, the IRS requires U.S. withholding agents, usually the promoter, league, or event organizer, to intercept a flat 30% of the payment. On a $10 million gross payment, $3 million is removed right off the top, ignoring actual operating expenses. Withholding agents must remit that 30% directly to the IRS and document the tax withheld by filing IRS Forms 1042 and 1042S. Losing a third of top-line revenue before factoring in travel logistics, expensive stadium rentals, and team payroll stunts a team's operational cash flow. Without strategic intervention, these default withholding rules engineer a severe liquidity crisis that can bankrupt a tour before it begins. The first line of defense against this gross withholding is claiming an exemption or reduced rate under an existing tax treaty between the United States and the athlete's home country. To secure these benefits, foreign entities must provide specific documentation to the withholding agent, generally Form 8233 for personal services or Form W8BENE for entities. The bottleneck in this process is that these forms strictly mandate a specialized tax ID. A foreign individual must provide an individual taxpayer identification number, and an entity needs an employer identification number. This creates a unique legal complication for foreign athletes arriving to perform under standard O1 or P1 work visas. Individuals present in the U.S. under these specific work visas are generally deemed ineligible for an ITIN by the IRS and must instead apply for a U.S. Social Security number. The issuance of that number is controlled by an entirely different federal agency, the United States Social Security Administration. This forces applicants into a bureaucratic loop. They must apply to the SSA, obtain a formal physical denial letter, and then attach that letter to an IRS Form W-7 just to request the necessary ITIN. Relying solely on treaty exemptions creates an unpredictable, multi-agency timeline that actively jeopardizes a team's operational launch. There is an ultimate federal mitigation strategy specifically designed to help independent foreign athletes bypass this trap: the Central Withholding Agreement, or CWA program. This comparison chart shows the CWA's financial function. Instead of the 30% gross withholding, the CWA transitions to a graduated tax rate based on actual net income, factoring in allowed expenses. This net calculation unlocks millions in operational capital previously held by the IRS. To initiate this program, the athlete or their representative must submit an extensive application, Form 13930, directly to the IRS. But this extensive application introduces a critical, immediate hazard to the operational timeline: a strict, unforgiving 45-day statutory deadline. A fully complete Form 13930 must be received by the IRS at least 45 days before the first event date listed on the application. If the application is submitted even 1 day late, the IRS rejects it unconditionally. The 30% gross trap snaps shut permanently. The athlete is then forced to file a final tax return, Form 1040-NR, to try and reconcile their tax liability at the end of the year, long after their operational liquidity has been drained. The CWA is a highly powerful financial tool, but its utility is entirely dictated by ruthless adherence to the IRS's 45-day chronological hard stop. Securing a central withholding agreement prevents federal overwithholding, but that is only layer one of the compliance architecture. The 2026 tournament operates simultaneously across 11 specific U.S. host cities, requiring continuous cross-country movement. This physical travel triggers a secondary tax threat, the state-level JOC tax. This map illustrates the complexity. Every state hosting a match imposes its own localized income and withholding tax rules on foreign athletes. Compliance must be mathematically modeled, apportioned, and calculated individually per city and per match against a fragmented set of state codes. Managing this multi-jurisdictional web is impossible to execute manually without a centralized, rigorous tax management strategy. The financial outcome of a North American tour depends entirely on how an entity prepares for these overlapping jurisdictions. An unprepared foreign entity will be crushed by the federal 30% gross trap and completely overwhelmed by the fragmented state-level tax codes. This split-screen cash flow model demonstrates the alternative. On the right, an optimized entity successfully secures a CWA, unlocks its operational capital, and accurately files its mandatory 1040NR and 1120F returns. Achieving this optimized outcome requires an external, expert framework capable of managing fragmented state matrices and strict federal deadlines simultaneously. Managing the volume of specialized federal applications alongside 11 distinct state codes frequently exceeds the capacity of standard internal accounting, making an external withholding agent a core component of the tournament's financial architecture. To bridge this exact multi-jurisdictional complexity, a specific operational solution has been designed, Tax Goal 2026. The architects behind this framework are JD Business Consultant, based in Florida. They act as the designated U.S. withholding agent and strategic partner for global sports entities entering the market. They handle the specific operational deliverables, successfully negotiating the CWAs, bypassing the Social Security and ITIN bureaucratic bottlenecks, and executing complete JOC tax compliance across all 11 venues. Securing individual tax IDs, projecting global expenses, and preparing a complete Form 13930 requires months of lead time before the 45-day IRS window ever opens. CFOs and sports agents managing these operations must secure their operational framework immediately to lock in their tax strategy. Partnering with JD Business Consultant resolves the multi-jurisdictional tax risks, allowing foreign sports entities to maintain their projected liquidity through the final match of the 2026 World Cup.